Good afternoon and Happy New Year. My name is Cherie Andre and I am the Client Relations Manager at Prestige Wealth Management Group. And I would like to welcome everyone to our Economic Update webcast. I will be the moderator for today's event, and as always, our goal is to continuously add value for our clients by helping to educate and keep you informed. Today's discussion will be hosted by Roy Williams, CEO of Prestige Wealth Management Group, John D'Angelo, Managing Director of Prestige Wealth Management Group, and Paul Esposito, who serves as our Senior Portfolio Manager. This conference call will be in the listen-only mode and should last approximately 30 minutes. No participation is required, and there's nothing you need to do except sit back and relax. We will take care of the rest. We can't take any live questions during this call, but we do welcome your comments and/or suggestions. So at the conclusion of the conference call, please feel free to send us an email with your comments and/or questions to pwm@prestigewmg.com. And with that, here's Roy.
Welcome, everybody, to 2020. I want to start out by, let's look back at 2019. When we look back at 2019, we did the same call. What we're looking at a global economic slowdown, the possibility, and there was talk all over the media, of a global economic recession. We're looking at the Federal Reserve increasing rates multiple 2 to 3 times more. We were looking at a possible trade war with China, and icing on the cake was impeachment trials, possibility of that as we went forward. And what really turned out was 2019 was a great year in the U.S. stock market. The U.S. led the way with international, again, lagging, and again, we'll talk about that a little later, but, a lot to do with the trade situation. And then, even fixed income, Paul, John, and I were talking, had positive returns. So, again, the markets are, and if we look back to 18, where companies' earnings were increased by 22% because of tax cuts, you would have thought 18 would have been a great year. And, again, the markets ended up being down in some areas significantly. So that's why we always tell our clients, the most important thing is to look at your goals, your objectives, and have the right portfolio. So in looking at the economic outlook, Paul, I know a lot has been, a lot of talk about the recession was based upon manufacturing slumps. Why don't we talk about a little bit about what's happening there?
Right. Well, I think, the uncertainty surrounding trade, Roy, was probably the biggest driver behind the manufacturing slump and really the earnings slump that we experienced, which crescendoed really in the third quarter of last year. Now that that's abated, we've actually started to see global manufacturing rebound. Actually, the most recent numbers that we saw, I know chart to the left here shows November reading in the expansionary level above 50. December's readings globally are about 51. Those sort of conflicts with the U.S. The U.S. did see a bottoming for the December number for manufacturing PMI, but we do expect that will most likely reverse, given the fact that there's been a lot of manufacturing output in Brazil, France, and a few other European countries that's reversing the trend. Manufacturing, I don't think has been, or that reverse is really the only thing that the markets have been discounting for the fourth quarter and into the future. You also have to look at a strong U.S. consumer, because if you look at the U.S. economy, 80% of it is service-based. So manufacturing does affect us. It really mostly affects global economy. But when we look at the U.S., it's predominantly service-based PMIs that we want to focus on. But with the low unemployment that we've had, the wage growth that we've seen in the fourth quarter, those have been a boon to the U.S. consumer, and have translated into better returns.
And John, you and I were talking about the Fed going from January of 19, increasing rates 2 to 3 times, and they reversed their actions.
Right. You know, starting really in January where they went to full neutral, and then going into the summertime when the Fed started to become accommodative and cut interest rates. Once we got some clarity around trade, things started to settle down.
Yeah, and again, trade is important, but again, the consumer, Paul, as you were saying, really is the engine that drives our economy.
Right, right. It's really, the opposite of, or should I say, all of the concerns and uncertainties of 2018 were quelled in 2019. I think that's probably simply put. It does, though, seem that central banks are, in fact, back to infusing additional liquidity into the markets. I know last year or year prior we talked a lot about, aside from central banks hiking or lowering rates as a means of monetary policy, they can also buy bonds, right? So that's when the U.S. Federal Reserve engaged in quantitative easing. That's an additional stimulus to markets. Right now, we're anticipating that. It looks like central banks are starting to anticipate that again. So if you look at 2019, chart to the right, we've actually had more cuts in 2019 from developed central market banks than hikes, which has usually portend to better liquidity, more conducive to risk-taking. Hence, that's what we saw in 2019. But aside from that, we're starting to see central banks focus on increasing, chart to the left, their bond purchases. And really, the Fed, in the fourth quarter, sort of did this covertly. They didn't engage in an all-out quantitative easing where they were going to expand their balance sheet by a set number and really telegraph that to the markets. There was something that came up and really didn't get a ton of media coverage, but in September, banks were having issues with overnight lending, the repo market it's called, and really what this did is it caused some liquidity scare concerns. So what the Fed has done since that point is they've actually been managing the overnight repo market. They've infused almost $500 billion worth of liquidity. So covertly, it sort of seems like the Fed has already started to, preemptively start their quantitative easing campaign, which I find to be.
Yeah. Let's go back to the unemployment rate. The unemployment rate, you continue to see, John, hit historical lows, continue to go lower.
Yeah, I mean, employment, I think, is driving the economy.
And the wage growth is also.
Correct. I mean, it's not just that the United States has been creating an incredible number of jobs. The jobs that are being created and the wages in combination, therefore, has created the strong consumer that Paul has been talking about. And the consumer is really carrying the ball through this part of the economic cycle.
Right. Another interesting add, John, is to look at the wage growth with the various wage brackets. We've actually seen in the last 30 years the largest growth rate in lower income workers, which, that has been the area just over the last decade that has had very scarce wage growth.
That's a great point, Paul, because as we look at the minimum wage implementation, as it gets phased in, it's definitely going to help, those individuals, in the lower paid brackets who always worked and always maybe will work at the minimum wage. $15 sounds a lot better than $9.
Right.
And, makes a big difference. So that's a great point. As we, go forward in terms of when we're looking at the 2020 market outlook, we're really looking at the economic outlook because the market, as we've seen last year, was unpredictable. I was at a conference Forbes puts on, and all the experts from MIT, from Wharton School, from every major brokerage house, from Fidelity, everybody, Vanguard, it doesn't matter. Everybody's wrong in their predictions last year. We were talking as a team, Paul, earlier about that. So even though we're saying, people are saying, what do you expect? Right, John? We don't know. I mean, we can position on the expectations, but nobody for sure knows because there's so many moving parts.
Right.
Well, and there's multiple outcomes.
Right.
You know, we happen to get a great deal on trade on a phase one deal. If it didn't happen, and the trade tensions escalated, where would we be right now?
Right.
So it's you know, I think the term this morning that Jamie Dimon used was Goldilocks, and if anything,
He's the head of J.P. Morgan.
Right.
For those who don't know.
Correct. The only thing that kind of worries us, I would think, would just be that there's nothing or less to worry about.
Right. Yeah, and what's even showing unpredictability is, you know, Paul, you and I were talking about the U.S. dollar. Expectations was the dollar was going to get weaker against major currencies, and because of the Iran situation,
Did quite the opposite.
yeah.
No. But no, to add, you know, I think the one takeaway from, you know, without putting ourselves out for an actual growth target for stocks, I think it's safe to say that it'd be prudent to not, in terms of expectations, given the fact that, you know, we do have some very fairly valued U.S. equity markets, and in some cases there are some stretched equity market valuations, not to really expect the same banner year in returns in equities, and for all asset classes for that matter. That was 2019 was very interesting in the fact that, you know, we saw.
Well, besides the fact we were coming off of the bottom,
Sure.
right? So we had that fourth quarter in 2018 that had the 20% plus sell-off.
Right.
So that, you know, I think really 2019, we talked about this as well, is kind of making up for 2018 plus.
Right, right. No, and you would have expected the complete opposite. I mean, earnings were really under fire this year, or this past year in 2019. We're now expecting 2019 earnings to only come in at 0.7% growth compared to 2018.
That's for the year.
For the year. Now, obviously, fourth quarter, you know, we saw a nice boom to earnings. We're anticipating a 3% growth, but when we annualize all 4 quarters of last year, pretty anemic. Again, maybe the returns that we saw in 19 were pretty much just the delayed effect of having double-digit earnings growth in 18, but having too many uncertainties with trade that overcame that.
And coming off of a much lower starting point. Right?
Sure.
2019, we're starting the year, or 2020, we're starting the year at market highs. You know, where in 2019 we started the year at really market lows. Right.
Yeah, and the Fed was really accommodating last year, too, by decreasing rates. You know, mortgage rates are back down to 3.5%. You know, you get a 30-year mortgage for 3.5%. You know, in terms of business lending, you know, I spoke to a client recently, you know, 4.5%, 20-year mortgage, which is a great rate for, you know, a commercial loan. So that also helps from an economic standpoint. And the Fed, you know, changing course was a big deal. And this year they're going to accommodate by not doing anything, most likely.
Yeah, and I think that's been important. It's been an important aspect of this late, I guess, the second half of the year going into 2020 rally that we've seen.
Yeah, and it's going to be interesting, you know, Paul, if a dollar actually does weaken as expected as we go through the year, you know, explain to people why that would be a boom, you know, our listeners, for the U.S. market. But why would that help earnings?
Well,
a lot of times people think of it the opposite of what will happen.
Right. So I think there's 2 things that'll affect, and this kind of comes into play with our positioning. And I guess we'll get into that later. But a weakening U.S. dollar for large multinational U.S. companies is great for exports. Number one. So it makes our goods more competitive. But also the weakness of the U.S. dollar also portends to stronger international markets. And you know, this is probably the reason why there's been a huge disparity in U.S. versus international performance over the last decade. Most of it's tied to the strength of the dollar, especially emerging markets. Emerging markets companies tend to fund most of their debt in U.S. currency. So when the strength of the U.S. dollar, you know, goes higher, it makes it more difficult for those companies to pay back those debts, and it puts a lot of strain on their balance sheets and profitability. And you know, the correlation isn't 1-for-1, but you know, going back over the last 40 years, it's pretty evident that, you know, what this chart characterizes, that any time we see strength, and it's very evident from 2008 all the way up till, you know, the end of this past year, the trajectory, by and large, has been a strong U.S. dollar, and that has portended to underperformance in international assets. It's sort of been the age-old question, why are international and emerging markets so cheaply priced relative to the U.S. market, and why is this price difference not being exploited? If we do see weakness, much like we saw from the peak of in '98 all the way down to 2008, if we start to see that weakening trend, we could start to see international markets lead. Now, international developed markets, there's still a lot of structural issues there. We look at the growth issues that Europe has.
The situation.
But Brexit, I think, is less of a risk issue.
Challenges.
Right.
Manufacturing challenges.
Pension reform.
Yeah.
I think those are going to be larger impediments to international developed markets, but emerging markets, on the other hand, don't have a lot of those structural inhibitions. So, that's from a positioning standpoint. In international, we've been historically underweight in international, overweight in U.S. because of this concern, but we're still within the international space for equities overweight in emerging markets because we think it's the better value. And if we do get a weakness in the U.S. dollar this year, we do think that that's going to be probably one of our better performers.
Yeah, and again, at the Forbes conference, it was predicted the number one pick was emerging markets last year, again, for the same reasons we're discussing,
right?
But it never played out. This year, again, depending what happens internationally, with Europe and what happens with the situation we have in the Middle East, because the U.S. is always the currency of choice when you have volatility. So the dollar will remain strong if we have volatility in the Middle East. So, in terms of, debt, there was concern last year, Paul, that, some discussion that, even the U.S. could go negative and, all the naysayers and conspiracy theorists thought that the U.S. was going to be in a position, but again, we reversed, and now, interest rates moved up.
I think the bond market led central banks into the decision of reconsidering negative rates. So if you look at the chart to the left, it shows in aggregate the total in U.S. dollars, that's trillions of global negative yielding debt. We hit over $16 trillion in the third quarter of last year, and that was, right, at the time that, the bond market was, I guess, fighting the Fed on maybe lowering rates a little bit further.
I also think it was a fear trade.
Sure.
Yep.
Right. I mean, if we get back to this last summer, we're talking about right on the back end of the Fed cutting rates. The trade issue escalated literally within 24 to 48 hours, and there was a lot of uncertainty around what effect that would have on global markets. And we saw the yield curve temporarily invert, and it really inverted based on that fear.
Yeah, right. And since that point, actually September, the European Central Bank's meeting with Madame Lagarde, she expressed her concern that negative rates, even though the Bank of Japan is still entertaining lowering rates to negative, is not a good idea for growth. Just because Europe's been experimenting with it, various other central banks have been for a better part of the last 5 or 6 years, and it is not creating any additional growth. Now, of course, the asset purchases are helping out, but really what that's led to, so if you look at all global yields, the U.S. we're the highest yielding house on the block. Chart to the lower right-hand side. We ended the year with a 10-year Treasury, as drum roll please, 1.92%. Doesn't seem like a lot, but when compared to all of the other government bond debt out there,
France, Germany,
Europe, Japan in particular, where they have negative yielding government debt.
Even Italy, which I consider a junk bond, is below the U.S.
Greece at one point last year had, which, if you all recall, back in 2015, 2016 with Brexit, that had high yield debts. Now they're all the way down to below U.S. 10-year. So very interesting. I think going into this year, I know last year bond returns were a function primarily of appreciation, not so much income as they're usually intended, and that was just due to rates coming down. This year, with the Fed being on hold, we're going to expect that most of the total return from bonds is going to be a source of income. A lot of the bond market right now, in my opinion, has underpriced inflation to some extent. You could argue that part of that is by design, but central banks wanting to keep longer-term rates lower so that, when they have to go and refinance debt in the next few years, they could do it at cheaper rates. But it wouldn't surprise me to see some sort of moderation back up in longer-term yields.
Yeah. When, there's a lot of talk about the trade deal. A lot of people are saying it's really not a trade deal because it's only phase one. Most people, it really hasn't been publicized. I've interviewed clients about, do they realize we got a trade deal with Japan, the third largest economy in the world? The answer is no. Most people don't realize that. And again, we're working on Germany and many other countries, but China is a big deal, and it is a big deal at least to get them to agree to something for phase one to stop additional tariffs. When I hear from clients that they're paying $200-300 extra for a washer and dryer, the tariffs were significant. So Paul, let's talk about in terms of the trade deal, in terms of the expectations, in terms of we were talking this morning, the three of us, about what are they going to do with agriculture?
Yeah, so initially phase one solidifies $120 billion of expected purchases, Chinese purchases of U.S. goods, most of that being agricultural. And then over the next 2 years, a commitment of $200 billion of purchases. Again, an initial shot to the arm for the U.S. economy, at least for, in the short run. Of course, that does come with the concession of the U.S. lowering tariffs on Chinese goods from 15 back down to 7.5. So it's good. I think it's a step in the right direction. There was some discussion with initial phase one of incorporating some of the intellectual property concerns, but it seems that phase two is really where most of that is going to come into play. That, along with currency manipulation, is what's going to be tackled during that.
Yeah, and what we mean by manipulation is the Chinese government arbitrarily just devaluing their currency because they think it's good for them, and hurting other currencies or hurting other economies, which is just not a natural occurrence. They would come in and significantly and sometimes devalue the currency. John, when we're looking at the trade deal in terms of intellectual property and China's economy, I mean, most people will tell you they significantly were hurt more than we were, and we had a discussion last week.
Yeah, I think that the administration put a lot of pressure on the Chinese through regulation and I'm trying to think of the name of the company in China, the one tech company.
Huawei.
Yeah, I mean they were literally banned from doing business in the United States for a period of time, and I think it caused the Chinese to come to the table a little bit when it came to negotiating. I think the tariff hikes also served the same purpose, trying to get the Chinese to the table because, at the end of the day, what we've been talking about, some of the theme of what we've been talking about today is that we're more of a service-based economy here and more of a consumer-based economy where it's still very important for the Chinese to manufacture. And those tariffs had a lot more of an impact on manufacturing and things like agriculture than service. So their economy was hurt a lot worse than ours was.
Yeah, I don't think they realized how many companies would move manufacturing and logistically on a dime relocate to India, to Sri Lanka, to other parts of the world, Vietnam, back to the U.S. I know, somebody who outfitted their factory with robotics and they moved it back, and they're more profitable by being back in the U.S. again, depending upon the kind of business and manufacturing they do. So it's pretty interesting to see how quickly U.S. and Europeans reacted to it. So it's good that we have a trade deal, even though we could all agree that it's not the best trade deal, but it's, at least we've come to the table with China and we're talking, and we'll continue to talk with phase 2.
I think the most important thing was just the fact that it de-escalated tensions and de-escalated, the situation, which created this nice little rally in the last quarter of the year.
And I think it's going to alleviate a lot of risk. I mean, that was the biggest, headline risk was trade, throughout the course of the year.
Especially with China.
Right, especially with China. So the fact that we have phase 1 solidified, signing into law rather shortly, the administration with the USMCA, otherwise known as NAFTA 2, I think is a good boon for market confidence in general. And, I think we're going to trade one set of uncertainties for the other. We are coming into an election year. There is going to be some expected volatility, surrounding that.
And volatility, most people don't realize in large cap stocks, we did not have a correction last year. Again, it's very unusual not to have a correction during a year, which we didn't. So don't be surprised if we do have that correction this year. And we can still end up positive for the year. But what's really interesting is, right now we're positive for the year. And, the Middle East was a challenge, right, John? We had a situation in the Middle East, and the markets are still positive, and gas prices haven't gotten to $5.
That's right.
Most people don't realize out there, listeners, that we are independent of the rest of the world when it comes to oil and natural gas. We're a net exporter. And continues to elevate in terms of our manufacturing capability.
Yeah, I think gone are the days, Roy, where you see the oil supply shocks that we saw, during Gulf War.
The 70s and the 80s and, the Gulf War.
The fact that, when that tension ensued in the Middle East, we only saw a 5% spike in prices, in crude prices, which corrected right back down to previous day levels, I think speaks to the fact that we are a good net exporter of natural gas.
But I would also agree. I mean, I think it's probably the bigger risk going into 20. It's probably a combination of election risk and geopolitical risk that could prop up out of nowhere.
Yeah. Again, most of the things that are going to happen, we're not going to be able to predict ahead of time, as with anything. In terms of look at your long-term strategy. Again, your portfolio should be based on your long-term strategy, not trying to predict the markets. Again, make sure you have liquidity met by having enough in savings. And again, risk management. We're a big proponent of risk management and look at rebalancing opportunities. In terms of, it may be shocking, but the Democrats and Republicans agreed on passing the Secure Act the end of the year. And again, there's more to the act than this, but just to highlight a couple things. It changed, and we have a few clients that were turning 70.5 this year. Now they have the option of delaying to 72, the minimum distribution. John, we talked about that. There may be reasons why you don't want to delay to 72.
Right. There may not be. One of the things you mentioned earlier was the qualified charitable distributions. That you can take from a distribution from the IRA, but I think it is great for some of our clients that are a little bit younger, that aren't quite as close to retirement, that they have the opportunity to be able to grow their IRA assets for another piece of time before they have to take those distributions. So it's, from that standpoint, the Secure Act is benefit.
Even clients who are over 70, we're seeing more and more people in the population working because they want to be on 70. If you're going to live to 90, 95, 100, people want to work and be involved and be engaged past 70. And now you can contribute to an IRA after 70.5, which you weren't able to do before that.
Yeah, I think that's great.
Yep. It's a long time coming in terms of adjusting to the longevity of the population. Again, part-time workers are now eligible for 401k. This is a big deal, and we really can't do it justice on this call. Inherited IRA distributions must be withdrawn in 10 years. So if your children are high earners and you have a large 401k plan, again, individual planning with Paul, myself, and John, and Michael, the advisors here, regarding does it make sense for you to take more money out of the IRA now in a 24% tax bracket or a 22% tax bracket, rather than your children take it out at 37 plus New Jersey 9. So 40, give half of it away. It may make sense to, do Roth conversions, as we talked about earlier, depending upon, again, an individual's financial situation. So, again, we can't do it justice on this call. Small business owners, tax credit of $5,000 for starting a new retirement plan from $500. And also, this is a great vehicle. A lot of times, clients want to use 529 plans as incentives. So for a GPA or graduation. So if you have a child or grandchild and you have money in a 529 plan, you can tell them that when you graduate, if you graduate with you can say graduate in general or graduate with a B or B plus, whatever average, you'll take the 529 plans and pay off the college debt. I think that's a great addition. So as more information comes out, as John mentioned, even though you don't have to take money out at 7.5 from your retirement plans, you still can a qualified charitable distribution. That means the checks go directly to charity, and it reduces your income that year. That's still a great vehicle, but again, the government can go back and change that. But we don't think it's going to happen because it's good for charity. All right, Cherie, thank you.
Once again, thank you for joining us on this webcast, and we look forward to continuing our series of these calls with you in the future. If you missed any part of this webcast, a replay will be available on our website shortly. We really do appreciate your feedback, so feel free to send us an email with your comments to pwm@prestigewmg.com. That's pwm@prestigewmg.com. Thank you, and have a great day.